SD Bullion has just launched Survival Food, headlined by the only 100% organic, GMO-free survival food. Prepare like the doc. Purchase your survival food from SD Bullion today.
Metals and Markets is sponsored by DNA Precious Metals, a near-term producer of the Montauban tailings mine in Quebec, Canada. DNA Precious Metals trades on the OTC BB market under the symbol DNAP.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets. Well, Eric, we had one more cartel bombing on a non-farms payroll release here Friday. Both gold and silver being hit pretty hard. The 8:30 jobs report, gold being sent under 1,300 support. It actually briefly broke below 1,290 with a low of 1,289. Silver traded all the way down to 2,120 as a low on the day. Silver actually recovered nicely later in the access market afternoon session, a little bit more strongly than gold, and got back just above 2150 support for a close of 2151. So a little bit of encouraging late day action in silver here. But this comes on the jobs report, which was a big beat of expectations at plus 204,000. Basically double expectations, which were 120,000. Meanwhile, the unemployment rate rose actually to 7.3%. And if you look into the minutia of the details, even though payrolls were plus 204,000, there's actually 623,000 full-time jobs that were lost in October. In reality, the numbers are not very good for the jobs market. The unemployment rate ticked up, even though almost 1 million, I think it was 932,000 Americans dropped out of the labor force in October. So just in 1 month, basically 1 million Americans dropped out of the labor force, that they're discouraged workers, basically. Obviously, a few of those are retirees that have retired, no longer working, but the large majority have dropped out of the labor force due to discouragement of not being able to find a job. So almost 1 million Americans and dropped out of the labor force's calculations, and yet the unemployment rate still ticked up. So not too promising for the economy, and yet gold and silver were smashed on taper rumor and taper talk because the headline number was plus 204K.
Yeah. And to put that labor force participation rate in perspective, we have to go back to the early 1970s. I think it was 1974 when we had the same number of people as a percentage of the population in the labor force. And that was as well at a time when it was quite frequent to have a single person in the family, the father being the primary wage earner. So it's just indicative of how much the labor force has changed in those passing decades, and it's not healthy. And on top of the other statistics that Doc had mentioned, there's other weird things about this latest 1-2 punch for the unemployment report and the GDP report. About 80% of, or about 80 basis points of a percent on the GDP was accounting to inventory buildups, which is a little strange because inventories are being built up in the second quarter as well too. And when you look at the retail report, where 65-70% of our U.S. economy is based on retail sales, you have to try hard to find retail companies reporting good news these days. I mean, Walmart has been consistently reporting down, which speaks to the weakness in the lower half of the economy. Saks is having trouble. Saks Fifth Avenues, their sales are not that great. This week we heard news from Whole Foods. While their numbers were okay, they were well below expectations, and more importantly, when speaking to what the management sees as ongoing conditions in the next 6 to 12 months, they're ratcheting down expectations. And Whole Foods kind of gives you a glimpse of where the upper middle class segment of the American consumer is and how they're feeling when it comes to how liberally they want to reach into their wallets. So, I mean, everywhere you turn, the consumer economy is rolling over. And this just feels like an effort to massage numbers right before the Thanksgiving, Christmas holiday season rush. And we saw something similar happen actually last year, and with the level of lying that's going on just about everything, no matter where you turn, whether it's economics or Obamacare or any other big policy, and for people who tend to define themselves as Democrats or / liberals in our audience, let me tell you, there was a vast majority of my life I define myself as a liberal Democrat. I don't define myself as anything. I'm nonpartisan for the most part at this point. But the production of lies is a bipartisan fiesta in this country. And as our empire devolves and as our economic system continues to creak under the strain of the shenanigans that we're playing, I have to stress that, it could just have easily been a Republican at the helm right now with all the craziness going on. But one thing is for sure, with each president that we've seen in the last 30 years, the level of lies continue to compound. It's like the exponential growth of our money supply also corresponds to the level to which our politicians lie to us. and you can see that reflected in the opinion polls, with Congress being at 10% approval rating, lowest in all of history of polling. Mainstream media, 17% approval rating, lowest of all history of reporting on mainstream media. I mean, most Americans are maybe not necessarily aware entirely of what's going on, but they know that things stink, that there's something wrong, and they can't quite put their finger on it. I suspect that within another week or so, having time to digest these numbers and look deeply at how they compare to the economic reports for previous year and previous quarter, be able to get more sense as to where the massaging took place. But there are things that we can see already that look pretty darn fishy.
The other big story this week here was the ECB on Thursday surprising the market in cutting interest rates 0.25%. We've been talking about for several weeks here on Metals and Markets the possibility or likelihood that the ECB will need to make some moves to catch up with the Fed and Japan as far as easing, and will need to loosen a little bit. And certainly they surprised the market this week and headed that direction by surprising and cutting interest rates, Eric.
Yeah, and 3 weeks ago, I believe, when we had Alistair McLeod on with us, we were talking about how the euro was pushing over, or threatening to push over 1.4 versus the U.S. dollar, and that France was beginning to send messages to the ECB and their German compatriots, hey, this is going to hurt our exports, can't worry, we have to do something about this. And it was clear in looking at the headlines of the day that this event was beginning to be pushed by leaders, so it's not entirely a surprise. And I suspect that this is also going to help Janet Yellen when she takes the realm of the Fed in January. And if we do, in fact, have a very weak Christmas, and then on top of that, the return of the debate about the budget and Washington, D.C. going in its usual direction of dysfunction, there's probably going to be a lot more open interest for another round of QE. And you add on top of that the fact that the bond market is beginning to back up again with the 10-year yield rising. It's now 2.75 if memory serves. And it was when it hit 3 that everybody at the Fed freaked out and said, sorry, we were just joking about tapering, because the Fed needs to be there as the buyer of last resort to buy bonds that the vast majority of the world has, in fact, seen the wisdom to curtail their purchases of our debt. And if the interest rates were to go to 4%, 125 basis points above where we are in the 10-year, that would just send shockwaves through the entire economy. And the housing market's weak already and is rolling over. And the interest rate derivatives market is super dangerous, and the policymakers are scared to death of that. And they're also afraid of how much more debt is added with each 100 basis point to the 10-year or any other section of the yield curve. Because you're talking about hundreds of billions of dollars of debt service that are added every year when you deal with just 100 basis points. It all augurs for the perpetual kicking of the can down the road and QE to infinity until the powers that be or the system forces the powers that be to do a reset of the global reserve currency system and banking system and holidays that would come to banks and whatnot. So that unfortunately that looks like the end game, because we continue to buy time and stall and not fix problems, and then the longer that happens, the problems compound, and eventually something is going to go wrong, whatever the black swan trigger will be, or flock of black swans as it may be. And that'll bring on a Cyprus on a global scale. It's really just disconcerting that policymakers don't want to deal with the reality. All they want to do is kick the can down the road.
Exactly. Well, with the big smash today, I wanted to give listeners a quick update on wholesale premiums and supply across the silver market here in the U.S. Last week we were talking about potential premium rises in the Silver Eagles, with the mint shutting down for 4 or 5 weeks here. I think December 9th is when they've announced they'll shut down until mid-January. And we did see prices raised across the board a little bit on Monday. They held steady pretty much throughout the week until today. Several suppliers raised them about 25 or 30 cents again today on the big smash here this morning on the jobs report. So Monday and Friday increasing a little bit, so we are seeing the Eagles premiums start to creep up across the board, really at all the suppliers, up about 40 or 50 cents now over the past week since that announcement was made by the mint. So seeing a bit of a creeping up in the Silver Eagle premiums, really no movement in the Maples or the Philharmonics or the other government mint. They've pretty much held steady throughout the past week, as well as most of the private generic rounds and bars and things like that. We're seeing a little bit of a shortage again of the 90%. Looking at all of our suppliers here, and all but 2 are completely out of stock here tonight after the smash here today. There's only 2 suppliers that have any in stock, and the one informed us that this afternoon they had 2,000 face left. So once again, 90% has been remain in tight supply. The suppliers that have any, it's almost day to day or hour to hour. I mean, when you're talking about a 2,000 face, that's not even a dealer order. So pretty much across the board cleaned out. So when the suppliers get some back in, look for premiums to be a bit higher on the 90% as well. But the rest of the main mint products haven't moved too much. So again, we'll keep our eyes on the Silver Eagles. They started to creep up in the premiums. Hasn't been nearly as dramatic of a rise as earlier this year when the mint suddenly announced a shutdown. We saw premiums jump $1 or $2 in a couple of days, but don't be surprised to see premiums jump back up towards $3.50, $4 an ounce come mid to end December when they're unavailable, the new ones anyways, from the mint.
Yeah, on a short-term basis too, it's probably not disconnected that we're seeing a level of manipulation this week and a ferocity that probably can't be matched, with the exception of big bombing raids like we saw, in the April 12 through April 15 window. The level of price management and the consistency of it, not necessarily the magnitude on any one specific day, again, but over an extended period of time in the last 2 months, has just been kind of breathtaking to see. And, that is probably keeping some of the buyers even away from silver at this point, because the sentiment is just horrible. I think now, given how many times we have fallen back after attempts of regaining ground within the precious metals sector, most recently in mid-August through September 1st period, the sentiment is probably worse than 2008. It's just a low-grade, constant torture that people have been going through in their whole positions. I mean, if somebody has a gold and silver position as an insurance, as a stacker, and they don't look at the prices on a day-to-day basis, and it's at a percentage base of their overall net worth that they don't necessarily have to sweat bullets over, that's one thing. But if somebody wants to be more aggressive within the space, this kind of aggressive takedown makes it very hard to sustain those kind of positions. But for whatever it's worth, it looks like Friday saw some action in the gold and silver equity space that's suggesting that people are beginning to nibble and on the assumption that the bottom for the near term is in, and that the cartel will hopefully take a break. Because if you look at things like the GDX, in the course of the day it went down quite a bit, but actually closed above yesterday's closing price, and saw about 2/3 roughly, just eyeballing it, about 2/3 of the volume on the buy side on the latter half of the day, as people were picking up the shares that were being jettisoned by people that were having margin calls and weekends and so forth. So there's no unemployment reports for another month, other than the weekly, which most people don't pay attention to. And we got quite a few days before COMEX expiration for gold and silver, so who knows? Maybe the next 2 weeks we'll see some repair. But with the level of attacking that's been going on, it's anyone's guess. We'll just have to see how things unfold.
Right. The bit of a positive encouragement was silver's trading at the end of the access market, getting back above 2150, but again, not too much to get excited about. But it really ended up closing only, I think, down 15 or 16 cents on the day after the big smash. And really throughout the week, we'd see repeated waterfall cascading events. And if you notice, if you looked at any chart at exactly 12 midnight Eastern time every day, it was back to, I think, 2170 or 2174 or something, almost to the penny. So outside of Friday's action that saw it close about 20 cents under that level.
It would be too much to ask the media to report on some of those patterns that happen over and over and over again, huh? You know?
Yeah, the algo patterns are pretty hard to miss this week if you're looking at the charts.
Yeah, I even saw a couple of stories where people were blaming the euro's decline in association with gold, and saying that because euro fell, gold fell, which was completely goofy. Even the fact that there's almost 2 hours of separation between the ECB's announcement and gold's initial decline, and in fact, gold was up going into that announcement. I mean, it's bizarre what narratives could be spun at trying to explain what are counterintuitive economic norms that have existed for hundreds of years, but that's the way it is.
And the same thing with this morning's gold and silver smash that began a couple minutes before the payrolls were released. So just getting the ball rolling. But so we'll keep our eyes on the Silver Eagle premiums next week. Look for them probably to rise over $3 on the retail level here in the next couple of weeks, as the dealers across the board try to order and accumulate what they can ahead of the Mint's 4 or 5 week shutdown. And hopefully we'll have a little bit smoother sailing next week with the jobs numbers behind us. Early in the week will be important for gold to get back above and trade back above 1,300. I'd like to see silver back above 22 as well before we get too excited. So for the Doc and Eric Dubin, thanks for tuning in once again to the SD Weekly Metals and Markets.
SD Bullion.